All right, all right, all right. Looks like we are live and in action. Okay, so hey, I wanted to come to you today and talk about a few very important things that are happening in the mortgage industry and might affect you. And really, I got to tell you, with what I get to do in helping families to purchase homes, experience that American dream, and then continue on in what we call successful homeownership. One of the things that we really like to talk about from kind of the beginning of the process and all the way through as we build relationships with our clients is successful homeownership and making sure you're in the right mortgage strategy to reach your goals, right? So, first and foremost, quick disclosure, I'm not a financial advisor. I'm not licensed to give financial planning advice. And a lot of what I'm going to share today is going to have some information about interest rates and things like that. But of course, you would want to reach out to us to get the full disclaimer on what rates and terms might be available for you. Everything we're going to talk about today is completely hypothetical. Okay, so now that we're through that, let me jump on and tell you just a little bit about what's going on in today's environment. So first and foremost, you may remember about a year and a half ago, there was a lot of news out there, a lot of news. And I don't know that anybody missed that news, that interest rates for mortgage loans were the lowest in history. And that was the truth. That really kind of hit the crest of that point in March of 2020. And then we saw a pretty big uptick in rates throughout the summer. And then rates came back down again into the fall and the end of the year. So a lot of folks have reached out to us, and we've had a lot of conversations over the past few months with people who feel like they missed the boat, right? Missed the bus, didn't take action. And first and foremost, let me encourage you with this. Analysis paralysis doesn't ever get us anywhere. So if you're considering, making a move with a refinance and you have that right information you need to make the right decisions, take action, don't miss the boat. Well, here's the cool thing. I've called this the time is now because it truly is now again. We are just as of this week starting to experience again the lowest rates in history. Those who we respect out there in the mortgage world are looking at what's happening and projecting that rates are falling even lower. So we want to get ahead of that and help you have the right information you need. So there's five reasons why you might want to consider refinance. And here at our office, I'm going to put contact info in the video below. Here at our office, we always deliver some excellent advice and some excellent information so that you have that right info to make the right decisions for you. So reason number one is to eliminate private mortgage insurance. Now, most folks know what PMI is. If you bought a home with less than 20% down, which yes, you can do, many people do it. In fact, it's a great way to achieve that American dream. But if you bought a home on a conventional loan with less than 20% down, you have what's known as PMI. If you bought it on an FHA loan with 3.5% down or even 10% down, you have mortgage insurance on that loan. It's a different type, but it's still mortgage insurance. Well, so many families we're helping to eliminate PMI right now. So you can refinance out of that mortgage. Yes, there's cost in a refinance. We'll disclose all that to you, help you walk through that. But eliminating that PMI can help you save hundreds of dollars a month in certain circumstances. Number two, lower your interest rate. Simple fact, simply put, lowering your rate lowers your payment. You have less money going out of your pocket every month, more for the things that matter to your family, more to budget into experiences, going on vacation, going out to eat, or put in the savings account, put away for a rainy day, put away for retirement, right? There's not many folks in adjustable rate mortgages these days, but some people use them, and there's various reasons why. And so if you find yourself in an adjustable rate mortgage, now would be a great time to look at moving into a fix or renewing that adjustable rate if that's your strategy. So you can move from adjustable rate to fix. That's number three. Number four, and this is a big one we're going to focus on today, once I'm done with the list, is consolidation of debt. Did you know that in America today, in our country, home values and equity are the highest it's ever been? Yet, what's also interesting is consumer debt is at the highest it's ever been. Now, there's a lot of discussion about, are we in a bubble? Are we not in a bubble? What's happening with home values? Blah, blah, blah. Here's what I can tell you. I was in lending back in 2007 through 2009, and I'm in lending now. And looking back then, the loans that were issued as a whole by far were much less responsibly issued than they are today. You may know this if you've gotten a mortgage in the past. It is an intrusion in your privacy in order to underwrite a mortgage loan, right? Here at Waymaker Mortgage, my company, we are doing everything we can to make the mortgage experience as simple as possible. But mortgage underwriting is no joke. You have to be qualified in order to buy a home. So we don't have bad mortgages like we did back then, and home values are being supported by appraisers. So the appraisers are actually out there finding sold homes as comparables to meet the values. And you may hear a lot of conversation out there, in the marketplace that, my gosh, this home sold for 50 grand over asking, this one for 100 over asking. Well, in many cases, the appraised value is very close. So all that said, if you own a home, chances are your equity gap, the amount that you owe versus what your home is worth, has grown tremendously over the past year, no matter where you live in our country, right? What that does is it opens up an opportunity to utilize that equity, pay off debt, save a lot of money. So that's number 4. We're going to talk about that more in a second. And then number 5 is taking cash out to make home improvements, which we're also going to talk about more. A lot of folks spent a lot of time in their homes over the last year, right? And so what we're hearing is folks telling us, I really wish I would have had a pool when I was quarantining, or I really wish my kitchen was remodeled or updated, or flooring or bathroom. So you can take cash out of your home's equity and apply that to home improvements. Here's what's cool about that. There's 2 ways. One, you can take the cash out and do the work yourself. We do the loan, you get the cash, it's yours, you do what you want with it. Second way is we can do what's called a renovation refinance, where we actually work with you and your contractor. We as the lender help to hold accountability in what the contractor's charging and making sure the work gets done, which in today's environment is a very valuable thing for a lot of folks. And then you have the ability to basically have draws come off of your mortgage during that renovation time, where you're making interest-only payments on a portion of it. It's almost like a construction loan. It's a really, really cool option. We'd be happy to discuss that with you. But bottom line is, number 5 is taking cash out for home improvements. So to recap, 1, eliminate PMI. 2, lower your interest rate. 3, move from adjustable rate to fixed, or vice versa if for some reason you desire it and it makes sense. 4, consolidate debt. 5, home improvements. Now, I'm going to share my screen and I'm going to show you a scenario that we built off of a client we've been able to serve this summer. Now, I kept names private and all that stuff, but this is a real live scenario. And I'm going to show you how this person is really, they've changed their life through consolidating some debt and home improvements, right? So first and foremost, this home was purchased in 2018. We're going to set the stage, set the frame here. Home purchased in 2018 for $225,000. They put 5% down. So when we came on the scene to look at this, they owed on their mortgage roughly $202,201,794 to be exact, right? So let me go ahead and share the screen here and just kind of show you what we put together for them. Hopefully that's coming through. So this is what we call a total cost analysis, and every single family, every single client we work with receives one of these in our office. We feel that this gives you the right information you need to make the right decisions. So if you've worked with us before, you are familiar with the TCA, or the total cost analysis. So this one is very simply set up to show a current mortgage versus what we call strategy A, which is debt payoff. And in this case, the property value went all the way up from $225,000 to $375,000. So that is a huge gain in equity. Now, the loan amount here that we were looking at from what they owed on their mortgage was just around $202,000. And then we've got the new loan amount for the debt payoff mortgage. Interest rate was 4.25. We take it down to 3 1/8. And then you can see the payment, interestingly, went down from $2,718 to $2,093. Well, that's really crazy cool. So if you look down here at their freedom point, it was just under 27 years. And we refreshed that and took it back up to 30 years. We may say, well, Scottie, why the heck would I do that? Why does that make sense? Well, here's why. First and foremost, they're saving $625.51 a month. Second of all, based on all the debt that was paid off and taking more money out of their equity, they're still saving almost $22,000 over 60 months. And then mortgage, mortgage insurance was completely eliminated. So that's a savings. So there's no MI on this loan. Their interest paid over 15 years on their current would have been $174,684. Well, gosh, look at that. Now, over the next 15 years, their interest paid out is $116,191. I just want you to think about that for a minute, because that in and of itself is super impactful to your net worth, being that if you would do something like this and you go to sell that home, let's say in 10 to 15 years, think about how much more money you're going to have in equity in that home, how much more money is yours at that point. So over the next 15 years, they're saving almost 59 grand in interest alone. Okay. So hopefully all that makes sense. Now, let's jump over here and look at this debt consolidation analysis, right? So here's what we did. We got a mortgage at $201,794, credit cards at $25,700, installment loan at $5,500. And all of the interest rates on these are significantly higher than a mortgage interest rate, right? And one of the cards was at 22%. I don't know if we have that showing down here. One was at 22, one was at like 16. I think the installment loan was around 10 or something like that. So let's look at this in two scenarios. Here's the current loan situation versus the proposed when we pulled the trigger on this. Current situation was 181 years, a long time to be debt-free. All right. Now that's making the minimum payments. That's what their, payment scenario was. And $174,684 in total interest paid versus with this loan, 30 years to debt freedom. So you may ask, why did it make sense to increase the term? That's exactly why. Of course, they can reinvest and pay ahead. They can, there's a lot of strategy we look at there as well. So if you want to do something like this and you want to own your home in say 20 years, well, we can tell you how much you need to pay, or you can do a 20-year loan, a lot of options. And then here's the kicker. Back to that $191,000 in interest, huge savings, monthly savings. Okay. So remember, current payment, $2,718, new payment, $2,093. And then we're looking at the short-term scenario over 60 months. Really just mind-boggling how little of that principal would have been paid on that $22,000 balance. And then, the installment loan would have been paid off, of course. And then you've got these credit cards. It's just crazy when you think about where you're at right now versus where you could go in that 5-year period. And then we look at the long-term scenario and we see where, there's just such a massive change in this person's lifestyle. And that's what I think is the most important takeaway, when we look at this type of thing is lifestyle change in your finances. That's a real thing, folks. That makes a huge impact. So if you find yourself owning a home, having any consumer debt, student loans, anything that might keep you awake at night or might make you feel concerned about your future and finances, reach our way. We'll have a confidential, simple, and no-cost conversation with you. We call that meeting, Does Refinancing Make Sense? And we want to help you have the right information to make the right decisions. Don't miss the boat this time. If you've been on the fence, if you've been in that, analysis paralysis situation, I've been there in my life before. I can tell you it's no good. It's not going to help you get anywhere. Reach out. Every person that works with us gets the total cost analysis, gets the personalized service from our loan strategy team, and ultimately can walk away making a decision one way or another. And you'll never get pressure from us here at Waymaker. We believe in making a way for the American dream to buy a home and then to successfully own a home for years to come. And if you're a homeowner and you're thinking, man, I would love to invest in other properties, guess what? That's actually number 6 that we didn't talk about. You could take cash out from your current home and use that money to port into a down payment for an investment property, vacation home. So there's so many options. Bottom line is we'd love to help you. Contact info is in this post below. Hey, if you find value in this, please do me a favor. Like it, give us a comment so that, Facebook will show it to more people. We did this as a Facebook Live, and then share it out to your friends, family members, coworkers. We work in a lot of different states. We have connections in every state. So even if our team for some reason can't serve, we can hook you up with the right person that thinks the same way that I do and leads with advice and education, not just trying to sell a mortgage loan. We are here to serve. And hey, I appreciate you taking the time. Have an awesome day. Cheers to your American dream.